We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back to the Capital Mindset live stream show, everyone. Let me see if this works. There we go. Okay. So today's topics are listed above, or sorry, for you guys, it's below in the title, as well as, I guess, a little bit in the thumbnail. This keeps like bucking out on me, so I'm just gonna have to keep it like that. This camera, for whatever reason, it is terrible at adjusting color. For some reason, it always wants to correct me to a more yellowish tint, and I don't know why. I gotta go into the settings and really correct that. Okay, but anyways, we're going to get right into the topics here. I'm going to get the first one right out of the way so we get onto the more interesting topics, at least for Andrew and I to discuss. I think one of them being the larger bet recently, and then we'll talk about Salesforce. I didn't put it in the title, but we are going to go over Monster's earnings. I did. Yeah, I know you wanted to talk about that.
I did, yes.
And we are going to be talking about Google. You see, right now the camera's like, oh, now you're back to normal color. And then it's going to change. It's going to be like, no, I want you a little bit more. So now you see,
or maybe like, you're just a chameleon and you're lying to all of us and you're just changing color.
That's another very strong theory. Okay. So the portfolio update should be fairly simple. So in the personal holdings, which I'll go ahead and start showing. This should be it. Okay. So, and by the way, for those of you who know who I'm sick, I am probably going to be back to normal by tomorrow. Right now, the only symptoms I have is just dizziness when I stand up. Other than that, pretty good. So, yeah, so when I'm sitting down like this, perfectly fine. All right, but nothing's really changed at the top of the positions, but there are some new positions that you might have not caught in wind of. Number 6 position, Sterling Infrastructure, which we're going to be talking about later. So I'm going to kind of pass on that one. So club members, you guys already know the what's going on with that one, what the deal is. But for public YouTube, this is the first time you guys are seeing that. And since the last update, so I know it's, we'll get into that one, I promise. Then the Salesforce, we're going to get into as well because they had earnings today. So, but nothing's changed. ACIC, that's one of the companies that I tried to be like a little bit discreet about it, but I failed, egg on face, because you guys were able to see it anyways with the pie charts, etc. So, and then towards the bottom, there's newer positions in ALSN, Fleet Core, Arista Networks, which wasn't there for the personal holdings on the last update. And the cells is where the majority of the changes happened. I did actually knock down Northrop Grumman a little bit. I'm sorry, Dan. Dan's not going to be happy with that. Small, tiny profit. We're basically break even on that position. And I did sell since the last update. This is not actually frequent, or at least it's not this week or anything like that. For as far as you guys know, it's since the last update. But Crown Castle, Intel. Well, actually, Intel was already updated in the last update. That one should just already be deleted. Park Lawn also was done. Murphy's USA. So this one was cleaned out of the portfolio. I recently sold a big chunk of the position, and then I sold the rest of it. As it got over $400 a share. It continued to rally. So for the time being, I am looking silly. I could have sold it for higher. And Andrew's not happy with my sell there. And then Paylocity, I free-thinked Andrew. No, I'm kidding.
I think the free thinking so far has done well for you, though.
It's done
super
really
short term.
No, it's done well because I was able to take the tax loss harvest on Paylocity the first time around. Then we wrote up Paycom, and then so we still kind of got similarly call it type of asset, same company almost, and then sold that, bought Paylocity, and made a little bit more on that as well. So accidental trading, but we also got the
swing
tax
trading, like winners right there.
Exactly. And then the other position, which again, for club members, that's not really new, but Palo Alto, we took advantage of that big dip that happened just recently. So that one's actually a bit of a more recent event. We can discuss Palo Alto later in this live stream if our viewers want to, but yeah, Palo Alto.
I think the most disappointing thing about Palo Alto is how much larger position it is than CrowdStrike.
Well,
That is
that's
a very sad thing.
yeah, that's just because when CrowdStrike well, I swear to you, CrowdStrike
You're killing me.
well,
It's fine.
yeah. Yeah, I'm sorry about that.
Hey, I gotta focus on my wins, okay? Okay.
I am sorry.
What's
It should be it's been disrespected. I don't recall if I did do in the last update or not, but I'll mention it anyways that I did trim down RCI hospitality by quite a bit. And so the main new positions that really want to draw eyes to is Allison, Fleet Core, Arista Networks, Palo Alto. Crocs was already discussed, I believe, last time, or at least last live stream that we had, and Sterling. But again, we're going to be discussing Sterling later in this video or live stream.
Wait, where's your Oh, right there, number 10. Okay. I just didn't see it.
The main, I guess, focal point of the cells, again, you got Murphy's, and then off memory, the ones that, Siltronic, that's the one I almost forgot to mention. So Siltronic made it briefly in the portfolio. It was another play in the semiconductor space, but more so on like a little bit more so on the fabrication side, but not as clear cut and dry as Taiwan Semi. I wanted to remove some of the, let's call it, less meaningful positions in my portfolio. I frequently go through this and see which positions I could probably do without, and that way I can focus more so on what I'm trying to capture. Oh, and there's also, because I'm trying to recall what the last update was for the public YouTube versus what I already updated to club members. So I believe that I did not do a public update for Games Workshop, which is a small position. It's more so like a fun position, but it's serious in some ways. And then CRH, which kind of plays into a bigger theme that I'm trying to pivot into, and that's infrastructure. But CRH is another pretty solid company. Our other analyst, Leo, he actually prefers a different company. And I think actually he could be right because it's more focused and concentrated. I just went with the largest player in the industry and it does everything at the same time. Maybe my returns might be less, maybe they might be more. Who knows? We'll kind of see. But that's not my main play in this. And I just wanted to go sort of with the, if I could call it that, a blue chip in this space. So that pretty much summarizes the portfolio update. Not really, nothing crazy really, and there hasn't been anything crazy for quite some time. So I don't know what to say about that because there shouldn't be something crazy all the time. Okay, so on to the news of the day. We had Coinbase website down because BTC has hit relative new highs at an all-time high.
No, it's relative new highs. I think all-time high is 70,000.
Yeah, so I got right here. So it is now 61,351. And so, of course, this has brought a lot of excitement around Coinbase. Coinbase website down. Too many people are going and onto the website, and people weren't able to see their balances. So I don't think that's necessarily all that bad of a news for Coinbase. It shows that there's a lot of demand, but it does show room for improvement or where they're going to need to make more investments. So I think I see it both as a good thing that they have a lot of demand, a lot of traffic demand for their website. But it's not the best look.
Coinbase is such a weird company because, like, will they ever not just be a Bitcoin proxy?
Yeah, I mean, they're an exchange, so they're gonna basically profit solely from the exchange fees of Bitcoin.
Right.
So, or all the cryptocurrencies that they trade on
the
platform.
crypto market. So, which makes sense, but it's almost like, I don't know. Well, that's what I'm saying. It's like as an investment, it's just a weird company because I don't know. I think it's kind of like, I'm not hating on the investment. I'm just saying it's like an interesting, difficult one to invest in.
Yeah, I mean, it's not something I'm interested in per se. Only just acknowledging that the crypto craze is back, and this brings us to a question I have for you. Do you think we're in clown market? The long pause, dramatic. He's gonna look back and say,
I'm going to read you a text I got from a family member today.
ooh.
It's a screenshot of Bitcoin.
Mm-hmm.
and it says, "I'm holding diamond hands."
Hmm. 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 Okay.
That
I'll,
was literally what it said. Um, it's okay. If we take a step back, things have run up a lot, but this is nowhere near, I think, 2021 levels.
yes.
There's the SPAC market isn't going insane. IPOs aren't even like a thing right now. I don't like venture capital. I don't think is like massively going off either. If a company has a bad quarter, it is being punished for a bad quarter. I don't think that was happening in 21. Like I don't remember like many companies getting punished. It it feels frothy but not clowny. Is how I would maybe say.
I mean, that's the conversation we had on the Icon the other day, correct? We were talking about how this is different
Mm-hmm.
than what we experienced in 21.
For sure.
And we had businesses in 21 that were just getting mega rewarded for no revenue, pre-revenue. So that was reminiscent, rhymed a little bit with the dot-com bubble, just a little bit. Now people are pointing to the AI bubble and saying, look, the AI bubble, dot-com bubble, these are the same thing. NVIDIA is Cisco.
That's it. That reminds me of like when people were saying, because they were trying to say like, oh, is the next housing crash coming? And everyone's like, oh, it's going to be auto loans. It's like such a smaller segment that I don't think it matters.
Yeah.
Like, you know, if the AI thing is in a bubble, then you have NVIDIA who's going to maybe take a hit if data centers go down and spend. You're going to have the guys that build data centers go down and spend. And there might be some companies that rely on AI that will get cut down. I will say, and I think we were talking about this too, is that AI is such a buzzword that annoys me now. Like when you pointed this out, it's like, what do you mean by AI? Is it an LLM? Is it an algorithm running in the background? Like, what do you mean? Because there's so much within that space. That's like being like, we're going to use the internet. Okay, well, how are you going to use the internet? Like, what do you mean? So
I'm going to Google things. I'm going to create a website.
yeah.
Exactly. Yeah, that's kind of the issue going around with every company that I can think of is most of them are now trying to fit in AI in some way. Some more legitimately than others, but
Yeah.
I think some of them are really trying to stretch it. Some of these insurance companies recently trying to just shove it in there.
Well, because like, and that's the point, right? So AI or insurance is gonna be like, we're using AI. It's like, yeah, you're using risk algorithms that you've been using for years. Is that what you mean? Like,
yeah, and an algorithm is not an artificial intelligence.
no, I know, but like,
so I know that's why it's misleading when they say that. They're like,
and I think that's the other thing is like, what even constitutes artificial intelligence? That's another question because I don't think any of this is artificial intelligence. That's another. I don't think anything's intelligent until it can extrapolate.
Yeah, the LLMs, I mean, we saw already what they do. They basically, for the most part, even like just guess or lie in order to extrapolate and give you information that you think it wants,
right?
Or
Because
that you want.
Because like, and we don't need to hit this topic too hard, but LLMs basically all they're doing is you're giving them millions and millions and millions of data points, and so you're saying, "What's the answer to this data point?" And it's going back and it's like using all the references. This is how I understand it. Not a data scientist, so I could be wrong. My understanding is, then it's going back, going through all the data that it's had, and giving you the answer based on that data. To me, that's not intelligence. I don't know if we'll ever truly have true what I would call artificial intelligence personally, but like my definition is just my own definition. So,
and sort of just not going deeper into what you said, but expanding sort of to the side of that. One of the things that we're going to get into it anyways with Salesforce, something they talked about with their Einstein AI, is their ability to, through these LLMs, get all the metadata across all their platforms and create usable LLMs. Because a lot of current LLM use cases, they're not very reliable. For example, and I love that they pointed this out, the Air Canada case where they were using a customer service language bot or chat bot, and it offered a customer something, and that customer didn't get it, and the airline was saying, well, we don't offer that. The chatbot made that up, and they were held liable for that. They still had to offer what they promised the customer. So that kind of brought into question. By the way, I didn't know how that got through their controls, that no one at the airline knew or was savvy enough with technology, because usually at those larger enterprises, there's someone who knows the limitations of these things. But that was, well, I guess most of the other airlines knew. It's just this one didn't. So,
Yeah.
What is this? Aren't we all a culmination of our previously learned information?
I want to respond to this because, first of all, I don't know if this is somewhat in jest or somewhat serious, or like primarily which one, because yes, but also we can extrapolate our previous experiences and AI can't in its current state. LLMs can't. So I have fought LLMs.
Yeah.
I have fought ChatGPT because I have played Dota and you could fight OpenAI. And I'm being facetious, but like really, what you learned was you had to have guardrails when you played them. If you did anything outside of those guardrails, the thing just like, if you did something that was a little bit unorthodox, the thing would break. Like it would just kill itself and like run down mid and continue to do that or something. Because in its simulations, that never happened. And so because something happened that it never saw, it was like, I don't know what to do. And so that's the difference.
Did it learn for the next time though?
That one game wouldn't be enough data. But like, so every time what they would do is every time it came back, it would be better. But like, okay, so they did this in, it's going to get better. They did this for 3 years, I think, from like 2017 to 2019, something like that. At the end, it could only play, you were still only allowed to play less than a quarter, I think, of the characters in the game. And there was a bunch of other like guardrails you had to play on, which just shows that it's going to, this is why I'm not like the old man yelling at the sky saying like, I don't like AI. I'm just a little less, like, I feel like people are just getting ahead of their skis on a lot of it.
Yeah.
And it can't think for you. It's a good lesson to, if you want to do, this is where you truly have to be a thinker, a free thinker. And you want to be able to learn to think, to extrapolate, to apply things in work, in life. And that's what's going to keep, like, if you're someone and your job is just doing routine tasks and not thinking and doing them better than the next person, yeah, this might be a problem for you. But if you can extrapolate and think, I don't think it's going to be a problem.
So jobs that require outside of the box thinking.
Yeah.
Imagination. Yeah.
Exactly.
Yep. My other point that I usually like to say to people is that I don't think there's going to be that many companies that are going to be pure beneficiaries of artificial intelligence, in the sense that they're going to be the ones using it or selling it, not using it, but selling it as a product to others, like a B2B solution. I think that a lot of people are putting their bets behind baskets, so to speak, that may not pan out the way they think. And I feel like there's only actually a handful of players that actually represent a legitimate case for future artificial intelligence cases.
How?
And I'm thinking of the hyperscalers in particular, minus Oracle and IBM.
I was going to ask, how has Copilot been received? Isn't it like pretty rough?
That's,
in its
to my
current state?
understanding, yes.
Yeah. Because that was going to be my thing, is like, eventually it'll work well. I don't know when eventually is, but I agree with you. I think that the hyperscalers, which I'm assuming you're including Meta in that.
Yeah.
Okay, good. Yeah, they'll benefit, I'm sure.
They're the only ones who can afford the infrastructure necessary to support and create those kinds of systems.
Yeah.
Yeah. And so either you're going to have to team up with them, or you're going to have your own. And for example, with OpenAI, they decided to team up by selling their shares to Microsoft. And in the case of Alphabet and Meta, they created their own. So,
right.
Which I guess that segues us nicely into Alphabet. I put a post or a poll for everyone watching right now. Do you guys think that the management at Alphabet should be changed right now? And I'll kind of give everyone a couple more 30 seconds maybe before we end the poll. By the way, if you're enjoying or you have enjoyed this live stream, feel free to actually leave a like there. And then 5, 4, I lied. It's not going to be 30 seconds. 3, 2, 1, end poll. Okay, so the poll results, yes, 82%, no, 17%. I'm surprised people said no. I expected this one to be well, it is one-sided, but almost unanimous, because that's the current sentiment on the internet. So I'll share my opinion later, but what's going on with Alphabet is a general decline in sentiment regarding their recent fiasco of image generation. So if you guys didn't know, I'll kind of get you guys up to speed. When you searched certain things on Gemini and you said, can you give me this type of person? Wouldn't do it, and it would give you something else. And so this caused a lot of controversy, and you would ask it, give me historical figures. And then it would give them to you in an inaccurate depiction. Well, this made a lot of people upset. And I think that when you saw the controversy coupled with their recent blunders when compared to OpenAI, because OpenAI seemingly came out of nowhere in a field that you would theorize that Alphabet had a huge advantage. Come on. Fabi, please forgive me. Yes, and no, no. That's why I'm saying this most recent one. There's been other ones, and so this coupled with those, I think sentiments kind of said, "All right, I'm throwing in the towel with you, Google." The price isn't reflecting that, by the way, but I feel like that's slowly picking up as far as the vocal population on FinTwit and other sites.
Google's culture needs to change, which probably means management needs to change. It's really hard to change culture without changing who the management is. And based on the memo that Bachai sent, I don't think he's the guy. Which, let's be clear, what do I know? But when he said, Gemini, some of its responses have offended people and shown bias, and that's unacceptable and we got it wrong. That sounds like you're taking accountability at first, but then you take a step back and why are you even saying oh, it's offended people and shown bias? It should just be our algorithm is not, or our AI is not doing what it should. This is a tool. It should just work. And it makes you start to question, does Google search work the same way? And I just don't realize it. That starts to come into question, right? So are there guardrails around Google search? Because I don't do the same kind of games with Google search, but are those same guardrails around them?
A sort of Gelman's amnesia, but for internet search engines.
I'm not familiar with.
It's the one that Bacon loves to tell me about. So it's usually referring to when you're familiar with the topic and you listen to a journalist talk about that topic and how wrong it is. And you say, wow, that's really wrong. But then with other topics you're not familiar with, you'll just trust them. So that's very common, by the way, because this is something I like to point out sometimes when I do the CNBC videos, because I like to pick on them, but journalist majors, I'm sorry, but I don't really value the opinions of them. So It just is what it is. Anything that's important, I don't really care to hear their opinion. But they have to, let me say it this way. I want to be nice. They have to sort of earn the trust. I don't explicitly trust a journalist.
I mean,
So,
no, that's completely fair.
Yeah. Yes. And so I'm flipping this around and then applying it to a search engine. So then you're like, okay, well, I use Google's product here.
Mm-hmm.
And you're like, oh, this is really wrong. Oh, this is really bad. And then are you going to say, oh, what if search is also the same way? I just never noticed before.
Right. I mean,
Yeah.
there's so much that I think needs to change internally.
Mm-hmm.
I don't, people will be like, and there are still people that are saying like, no, Google's AI, it's great. I'm like, dude, they failed the rollout twice. They failed this, because you know what Gemini is? Gemini is what they used to call Bard, and Bard's rollout was so bad they called it Gemini. Like, they're like,
they just renamed it, right?
Yeah. Because there was so much negative sentiment already on Bard, because the Bard rollout was a disaster.
Yeah, because I remember that debut. Yeah, that was bad.
Yeah, in like the presentation, it gave the wrong answer.
Yeah, that was
what
bad.
will the next name be? Bard was a weird one, anyways. Sing me a song. I don't.
Yeah, so this is something I was discussing with yourself and other members. That let me share this. So like I wasn't selling any Google, but Google's been falling down in allocation simply by virtue of not getting any net new capital. And so Amazon now overtook it. If you guys recall, there was a time where Google was there, and it was Netflix. Yeah, I just didn't notice the Netflix. Well, that makes sense with all this rally that we've been having with Netflix. We're almost at $600 a share, which is absolutely insane, because just the other year, it seems, this was a company that couldn't do anything right and had shitty content. Disney was going to destroy them, etc. But anyways, not to talk too much about them. So right now, what kind of I've been doing with Google is my way of punishing them is not adding net new capital, but I'm not going to not say that I haven't thought about it. And that's a big deal for me. And it's actually somewhat challenging for me to let go of it. And that's bad, because I shouldn't be married to a stock, but it's a stock that I've held since the beginning. So it's tough. It's tougher than I thought,
No, I've sold some. I think you know that.
Yes. And you know what, if kind of this is not saying this is what I'm going to do, but honestly, what I would rather do is trim at least some Google and probably reallocate that capital either into buying more Amazon at this price. It's still within my nibble range, but it was so much more exciting before.
I think there's some companies out there that are really exciting, actually. Like, that's the difference. That's the difference today versus 21.
Mm-hmm.
Like, in 21, you're like, I guess I'll pay like 50 times earnings for this company because I don't have anything else to buy. Like, or you're just selling. Like, those are your two options.
Yeah.
So.
Yeah. Then part of me, I mean, you've heard Bill Ackman's statements on it. Not saying that he is the arbiter of truth here, but
Ackman,
isn't that wrong on it?
He's also outside of his circle of competence. He got burned bad on Netflix.
Wait, just want to say, heck yeah, Henry. See, I'm a big you guys. I'm not saying you guys particularly, but by the way, if you guys are curious, we have a lot of newer subscribers because we were a much smaller channel back when I pitched Netflix. You guys can go check out the older Netflix videos. There is a long video that's like the actual pitch on Netflix when Netflix was really down. You guys almost turned me into a Netflix fanatic because you know what it's like when everyone's like against the idea and then you're like backed into a corner. So then you become a fanatic of it because you're like, no, I'm right.
No, it kind of happens too when the stock price goes a certain way, and you're like, I don't see that, and you're like, am I crazy? What's happening? And then if other people start to say, no, you're wrong, you're like, no, like, I'm right.
I'm right.
But in regards to Ackman, like, okay, he is way better than me at this. He is way smarter than me. I don't know if he's right on this though. He doesn't normally you have to remember Bill Ackman is a legendary investor. In his circle of competence isn't really tech though. Like I don't
Mhm.
what's his best tech trade or play that he's done?
You know what? You say that, and I can't recall. I can recall the restaurants,
Right. Well,
and I
he's
can recall what he did with Hilton.
he's a legend at all of that. Legend. Best. He's the best at that for sure.
This I can tout, but his Chipotle, and you see, like, Chipotle is bad because Chipotle should have been obvious to me. I frequent them too much. I've been frequenting them too much for years now, so that should have been obvious. I didn't even bother. Like, I'm not even joking. I didn't even bother to look into them as an investment. That's how bad that was. It is entirely my fault. But yeah, I think that's the prospects, or the idea that he's really wrong on this. And Alphabet's his largest holding now, isn't it?
No.
No?
No, let me check. I don't let me see. No, it's still Chipotle.
Okay, but where is it? It's like number 2, number 3?
It's actually maybe it is his largest.
You have to add them. Yes, it's gonna be his
Yeah.
largest. Add them together.
Yeah, it's slightly larger than Chipotle. So yeah, it is
Wow.
largest.
He's betting big. He's betting big on the Gemini train.
Well, this is my hope because what is Ackman at his core? He's an activist. Yeah.
Yeah.
Yeah. So I'm like, maybe I gotta go look up if he's got history of Slootman.
And asks the question, do you guys invest any of your portfolios into any funds? I do not.
By funds, do they mean like PE funds?
I think they're referring to just ETFs.
Oh, I do. Yeah. I'm majority ETF. Majority S&P 500. I also hold VT, for those of you that wonder.
You do?
Yeah.
What? I did not know this. This is news to me.
Yeah, no. So I have, when I show like my portfolio, obviously single stocks. I'm not showing because who really wants to see so the way I have it broken, I have separate portfolios. So like the one portfolio I show, that's all. It's always been single stocks, and then the majority of my holdings is in my 401k and so like those portfolios, 100% single stocks.
Oh, like your 401. Yeah.
And then I have 401k and some other retirement accounts that are just fully ETFs.
Yeah.
And so I hold it's primarily just a zero cost S&P 500 index and then VT in those.
Yeah.
In my single stocks, in my active portfolios, no, I don't have anything. But
I trimmed Rick as part of for both the holding co and my personal holdings, as far as just getting some capital to work elsewhere. So not really anything. And the timing was actually quite lucky, but the reason or the rationale for it is wanting capital for other plays. And so I routinely look at other let's say positions as to what can be cut, so then I can reallocate capital to either a core idea or something else like that. Okay. So yeah, I don't own any funds, but I recommend them. So you should.
yes, unless you're someone that has a history of investing, and the history is very good, and I think you did it professionally for a while. don't advise that. I don't advise anyone do that. I even advise you don't do that, but that's besides the point. LeBron changes his sentiment depending on Google's price. Who's LeBron?
Oh, that's the inheritance gremlin.
Oh, I was thinking like LeBron James.
This is a very interesting theory. I've slowly but surely accumulated an activist position in PayPal. We could talk about PayPal briefly, but
what is there to talk? Because I just think it's a stock that's talked about too much. Like, it could work. I don't find it particularly interesting. Like, why don't you wait to see if the turnaround actually happened and then buy? Is just kind of my.
Yeah, and there's just so much more interesting businesses out there that while you kind of have been, not saying you specifically to the commenter, but individuals have been just sinking their capital into this. You had plenty of other opportunities. Now they might be arguing, oh, it's like a spring. It's eventually going to just pop.
Mm-hmm.
I don't think so. I think the reality has fundamentally changed for PayPal. There are scenarios in which they'll do well, but
I mean,
that doesn't mean that there's not other opportunities that will do even better. And that's usually my point.
Saying a company is a spring that's finishing up pop is like the most copium, like, BS I've ever heard. Like,
the theories are expanding.
I mean, I'll say it. I don't think Palantir is necessarily a bad investment. I think its valuation is too high. It's a real company and it does real things.
Yeah.
You could do a lot worse than that. But with PayPal, I think a lot of people on YouTube want to have the hero syndrome of, I got it right, I called the turnaround, and I bought the bottom. Which, like, if that happens, good for you. I think that's a bad way to approach investing, unless you, for some reason, know it's going to turn around. Like, you're very confident in that. But the fact that they have a brand new CEO and all this, there's no way you can feel that confident that they're going to turn it around.
Mm-hmm. Yeah.
And so my thought is, a lot of people just want to have that running into the burning house, I'm going to, save everyone kind of syndrome. Instead of just saying okay, let's just see what happens after a couple of quarters. Because if it's truly going to get turned around, you'll have time to get in.
Can I say something that's very interesting to your point, though? When that scenario happens, usually, because I'm going to say the two examples, there was also Unum back in the day, but the two examples that was public on YouTube, Netflix and Meta. I think both of those were examples of running into the burning. What do you notice was the attitude of the average investor, though? And how is that different from the attitude of the average investor on PayPal? I think it's very different. I think you have with Netflix and Meta, and there were other examples too. The house was burning, but everyone was afraid of the house. No one wanted to go in.
I think that you're looking at retail sentiment, though. I don't know it's sold off a lot. I don't know what the sentiment is from institutions. Because dude, with Netflix, you literally had Bill Ackman writing an apology letter. You had Jim Cramer crying on TV about Meta. The dude, he was crying on TV. Yeah. Can we just appreciate that fact? This man was in tears.
Where is my crying TV host for PayPal? Where is he?
The difference is no one cares about PayPal. PayPal's just, this is my thing. It's a boring stock in a boring industry.
Do grab your phone, open the app called Twitter, scroll to see how long it takes. Maybe it's just my feed. How long it takes for you to get $PYPL tweet and just a chart saying, look how cheap it is.
Well, okay. If we want to talk about how cheap it is, the question becomes, what Like, what kind of terminal value do you assign on a company that has a net income declining?
Yes, I think that that's something everyone missed. When some people sent me clips of other people's coverage of it, and then some of them I would watch the full video, because sometimes I
Mhm.
like to watch only the clip that someone sends me. I'll be like, okay, what's the full context? Because okay, that part's interesting. Like, it's kind of silly. What else did they say? If it's not too long. But what I'd find is none of them really caught that, and I found that
Well,
interesting.
it was really funny because I think when we were talking about it first, like I didn't even go that deep into it, but it was very obvious to me. I was like, their net income is declining because their EPS is staying the same and they have a massive buyback program. So A plus B equals C. Like, if you're buying back shares, but your EPS stays the same, that means your net income is going down.
You're projecting, yeah.
Right,
Yeah,
right.
because you're doing an EPS calculation,
Right.
EPS projection. Yeah.
Well, yeah, because they reported their guidance in EPS.
Yeah. Yep.
Like
Yeah, and
yeah.
garbage goober. That is to what we're discussing. Yep. Not They didn't guide the net income per se. They guided the EPS.
Right.
Per share, earnings per share.
So and they're also guiding that they're going to net buy back shares. So if the share count goes down, but your EPS stays the same, it just means that your net income is also going down.
Yep.
And so, and this company at some point will bottom their earnings and probably start to find a base and go up again. I got to imagine. I don't think the terminal value, but like, when does that happen? What does the net income growth even look like? All these questions. It just makes it uninteresting to me. Like, to me, I just get bored listening to or hearing people talk about PayPal or like even talking about it. It's
Yeah.
like, oh, do you want to talk about checkout buttons? Like,
Well, speaking of which, I listened to a really interesting argument from Chit Chat Stocks, right? And it was on
I like
PayPal. And the PayPal argument, or not the PayPal argument, the PayPal case study is that they probably kept their take rate a wee bit too high for too long, and that allowed a lot of competition to come in. So all this
Really?
competition that came out of nowhere was probably a byproduct of, okay, they had this really strong early mover success, but they didn't keep the competitive drive, and they were like, well, we're just going to keep our take rate really high because we have this network effect, but not understanding that in and of itself might eventually erode that network effect, which is their strength. And they still have that, but that's not immune. So
Yeah, it's almost like, maybe renegotiating contracts with large vendors and taking a lower take rate isn't the worst thing in the world.
you want to talk about that?
No, we're not gonna
Okay.
talk about that.
I was like, you want to get into that stock? We can if you want.
No, we don't have to.
But yeah, PayPal, there's better opportunities. Now, Salesforce. Okay. Salesforce, CRM stock. Full disclosure, I had calls that I sold, not purchased, sold, that expired this Friday, and that sucker who bought them from me, they're going to expire worthless for sure now. Because the implied movement, what you could get as far as yield goes, was insane on Monday. It was insane. So now Salesforce, as far as the pitch goes, back in 2022 was quite a similar pitch to that of Amazon. Not exactly the same, but the recent call, it's much more of the same. So they're executing on all the criteria that we kind of laid out in that initial pitch, and then we're seeing just consistency on that. So I don't really see a need to cut the position at all. If anything, I would be looking to build it out even more if there's any meaningful pullback. But this doesn't constitute a meaningful pullback. If anything, it's just
So,
a boring reaction. So
what are their products again? I'm not in Salesforce. They have obviously Salesforce, but then are they also Tableau
yes, they bought Tableau
and Slack?
Slack. They bought Slack. They have a bunch of in-house, you could say, products B2B products. The one that they were touting the most was Einstein. So
What's that?
So they're rolling out like business intelligence products. The one that they're talking about the most in today's call was go figure AI. Slack basically like Discord. Yeah, it is, but more serious.
It's more. I was gonna say it's more. I'd say like a Teams, or like Zoom, Zoom, or what was the one? Skype. Skype.
God.
Remember Skype for Business?
Thanks to Salesforce, Tableau, and Slack now suck. I've heard that. Yeah.
Well, that's like the Broadcom buying. What was the cybersecurity company that they bought? They didn't buy Trellix, was it?
No. Wait, they bought. Wait, you're not talking about VMware.
VMware, yeah.
Okay.
And you should see. I'm on like some cybersec forums and stuff because I've never used VMware, and it's like, what company do you hate dealing with? Everyone's like, dude, ever since Broadcom bought VMware, they suck. So it's the same. Yeah.
I wonder what they changed that made it so bad. And
from what they were saying, I mean, one of the things, and I wouldn't be surprised if a lot of these guys do this because they want to find like operational efficiency, is cutting a lot of like customer service, account management things.
Yeah.
Which is an extremely important part of a business. Like if you're not, they're trying to turn it into a subscription model. Yeah. I mean, but like some of the feedback I've heard is just like, it's difficult to get a hold of people. And like, if you're B2B SaaS, you have to be able to make sure the people that are paying for your subscription are getting everything they can. You want to make sure they're getting every dime out of that subscription.
Yeah.
And so that's why that aspect is so important. So anyways, one of the things I've been doing in my company is making sure that we're getting every dime we can of every SaaS subscription that we have. And like a lot of it's just like some companies, you call them like, oh yeah, here's your account manager, here's your CRM rep. We're going to set up weekly calls. We're going to make sure you do everything. Other ones are just kind of like, and the ones are like, and we don't have them anymore. So.
But the thing is that's interesting. So for some of those, are they replaceable in your eyes? Is it worth going through the trouble of getting rid of them? Or some of them still works fine enough and it's too much of a hassle to get rid of them?
I got rid of everyone that I didn't like. But okay. I'm also the kind of person that's willing to like, I don't think everyone's as willing. Like, for example, we got rid of our payroll company because they were like hell to work with. And a lot of people were like, oh, that's a really difficult transition. I thought compared to some of the other ones I got rid of, it was relatively easy. And so maybe it's also, I just am fine like dealing with this and like sucking it up. I'm
going to pull this up because with the highlights in Salesforce's results, I'm going to get the exact figures out, but pretty much across the barometers that we were looking at, which is profitability, they killed it, and they continued to kill it. Now,
Salesforce.
Yeah, Salesforce.
Okay.
Now, guidance was what kind of came out a little bit disappointing, but I feel like that's Now, the growth that they're pricing in, I think you're still kind of asking for a lot, which is why I'm not too excited to build it here, add more here. I want a meaningful pullback because I don't really see a huge amount of growth from Salesforce in the next year or coming couple years, besides from any further efficiency gains that they can squeeze out. Because, when I say these figures, it's like I'm kind of still penciling out mid to high teens growth. But they're with a 36 handle, you're kind of.
Do they own an accounting software?
Like a black line?
Blackline wouldn't work. Blackline's not. No, I'm talking about like a primary like ERP system.
I don't think
feel,
so. I think their next growth avenue is going to try to kill Viva Systems. You know about that drama between them?
Isn't Viva? Is that like it's like a very specific CRM
Yes,
company?
for
It's like healthcare. Yeah.
And they had an agreement with Viva for a long time that Viva built their product on top of the Salesforce ecosystem. And then Viva, their contract was ending. I think like, let me look this up, but the Viva contract ends, it already ended or it's ending in soon.
Because Viva's public, right?
Yes. And
yeah.
the stock has been, yep, there it is, September 2025. So it's ending right around the corner. And Viva's been working really hard on building their own system independent of Salesforce. Because as soon as that agreement ends, Salesforce can come in and really try to push for their customers. And so that's a whole other market that Salesforce can somewhat grow in. It's not going to provide them insane amount of growth, but it could be.
But Viva's not a small company. I mean, they're 36 billion market cap.
No, they're not.
I don't know what their revenues and earnings are, but.
Well, their share price has been struggling over the past couple of years. It hasn't really recovered because of that overhang.
Right.
Because now you're saying, well, now the behemoth Salesforce is going to try to take your lunch.
Well, yeah, and well-deserved overhang. I mean,
yeah. Because it might not be that they take their customers. It could, because the other thing that people need to realize is it's not about losing your current customers. It's about losing growth potential. So maybe your growth gets slowed. And if you were priced previously for a certain growth rate, and now that growth rate is not going to be what it once was thought to be, yeah, your share price is going to come under pressure. And I think, yes, Viva has a, according to Google, price to earnings of 60.72.
But those are always LTM numbers, so I don't know.
Yeah, and I'm going to,
because I think on that same thing, Salesforce is like 100 and something. That should be a pretty big growth avenue for Salesforce, because I bet you Viva's
46 forward.
Yeah. What's Salesforce?
Salesforce is 36 forward.
Okay.
36.5. So yeah, Viva is going to have their fight soon, and some of you might get interested because it could get really hectic for them. But
yeah,
I don't know if I'll play with that.
Neither. I've just never been. I will say, because just so you know, lots of most. And maybe it's because Salesforce is focused on enterprise, and enterprise is a completely different business model. Never mind. That's probably why.
Which one were you thinking about?
Well, almost all the CRM solutions that are in my industry or in my like the SMB space that I play in, that I work in, like at that size, they're almost always have either, it seems like they buy a ERP system and then they integrate, because the integration makes a lot of sense, right? You have your, but like the thing about CRM is it's for enterprise. And when you get to enterprise, then you have things like SAP, which is so massive, because I've also worked on SAP, and at that point it's like, okay, we'll just have integrations between these built in, and it'll basically feel like it's seamless anyways. Because at that point you have like your own, because I don't know like how because Salesforce, correct me if I'm wrong, it's primarily focused on enterprise, right? Like I'm sure there's some smaller codes. Yeah. So then it's a completely different ballgame then.
Yeah, it's their bread and butter.
Yeah.
The reason Swag Piggy Fig, and this is, I mean, who knows exactly why, but it could be that they were really amping up their new product. They're gonna have an event next week that's gonna unveil it. And so Mark Benioff was doing a really good job as a salesman, getting everyone excited for that product. And then again, he was, well, this was towards the beginning, but he was highlighting again and again and again the promises and their accomplishments. They fulfilled their promises, etc. So, hey, no problem, Jim Bob. Happy you enjoy it. If you guys are also enjoying it, feel free to like the video or like the live stream and subscribe if you're also new. Okay, so that covers Salesforce, and I think we're going to discuss the next large bet or Monster. I'll let you choose. The
Let's
next
do
large
Monster.
bet, you know which one it is. Monster. We'll do
We'll
Monster.
talk Monster
Like,
because I want to open up my Monster and celebrate my win today.
okay.
As cringe as that is.
Enjoy your Monster.
No. So it was funny because this Monster's a funny company. For those that don't know, they're like Google in the sense that they don't give guidance. They don't. Their IR for like a company their size is the most bare bones thing you've ever seen. And so I feel like sell side analysts are always off with their estimates on them, or like they have a hard because they probably don't get to talk to management as much. They have a hard time modeling out everything, but also Monster sells everywhere, which makes it hard to like figure out things. But it was funny because like the numbers came out. I was like, holy, it's not 8 p.m. What you mean? It's 7 p.m. I agree. 8 p.m. is too late. At 7 p.m., you're okay though. So anyways, on to Monster. Where was I? Oh, dude, this is a Staples company. They have a Staples multiple. So like, if you look at, let's just say, I'm just gonna like Coca-Cola, Pepsi bottle, Coca-Cola glass. But Coke, they trade at like a 21 forward price to earnings. Monster sits around a 30 forward price earnings. The difference is Monster just grew year over year their net income by 21%.
Yeah.
Like, that's insane. And their sales grew by like 16%. Okay. All that's good. And then you get into the call. And the call is even like better in my opinion. First of all, they're a sell to China company, and sales in China are growing 51% year over year. So like they're just getting into China, which will be nice. And then there was a question on the call. I wonder if I play it. You might not be able to hear it. I played on my phone, but I'll tell you. So the person goes, so their gross margins come out, and like, I know guys, this is really fun stuff talking about gross margin. To me, this is fun though. And it was like funny. So the analyst says, well, your gross margin comes out at 53.5%. So remember, and I had said this, Monster bought their own facilities now. So they're the only ones like out of any of these companies that owns their facilities. I mean, obviously Coke and Pepsi do, but like these energy drink players that own their facilities. And over time, that's going to increase your gross margins, right? So someone asked, well, and gross margins came in higher than expected. But someone asked, is there any reason that your gross margins can't get back to 60% where they were during the pandemic? And the CEO goes, yeah, the reason they can't get there is because we don't give guidance. Otherwise, it'd be able to get there. It's like, okay. He's basically saying, yeah, we're going to have like gross margin expansion. The other thing is their net income also came. They had a couple one-time impairments for like $50 million. So actually their net income on a run rate multiple or a run rate amount like grew even higher if you back out that 40 or 50 million. So like you back that out, they're going at like, I don't know, like 23%, something like that. So overall, just like great quarter. It's a great, I mean, like you look at the reports, the same thing every time. Oh yeah, we grew by like 15, 16, 17%. Net income grew. Whereas their earnings calls are just them like giving a spiel on all the different companies or countries they sell in. But that's Monster. Monster in a nutshell, very good. Deserves to be up 5-6%. I could understand if it's up more tomorrow when they give that gross margin guidance. They just continue to execute, and I think they're not done growing for a long time, in my opinion. Which actually you could say maybe makes Celsius more interesting because you're saying the market's just that big. like it almost makes you think maybe Celsius is interesting because this ramp is so large to grow into. But there's execution and international expansion that you have to look out for Celsius.
Celsius is another one that the retail crowd is like crowding into recently.
That's another thing I should say on the call, because I said this, but so one of the things that retail likes to point out is Nielsen numbers. And Monster even said this in the call. Monster's like, a lot of our sales don't hit Nielsen. Like Nielsen doesn't reflect, it's not an accurate representation of how our company's actually doing. Like, I mean, they get a large amount, but there's a lot of sales for people that don't go through Nielsen. By people, I mean companies. So,
to Michael Anthony's point here, CLH Celsius has no debt, but Monster has no debt too.
So here's my thing, and I'm going to say this till I'm blue in the face, and I've said it before. Celsius is a company that's run extremely well. Like they have done a great job breaking into the market. They're doing an amazing job, extremely well run. There's a lot of potential growth if they can execute on their international strategy. And I don't consider Canada to be like completely international because the culture is so similar to America. Like, okay, let's see we'll see. And like, I don't know how the Canada expansion is going. The problem is just the valuation on this company is at crackhead levels, in my opinion. Like
88 forward, and then what's the current?
You're talking.
Yeah, it's an 88 forward P and 141 current.
When you're more expensive than CrowdStrike, like you better execute.
Any slip, and this thing's gonna. Oof.
And like you're a CPG company with, very good gross margins, but like 45% gross margins, compared to like CrowdStrike at like 80%.
Celsius is a SaaS business.
You're saying don't disrespect the maple syrup and take back my comments. Okay, well we'll say Canada's completely different culture than America. My total return on Monster, I have to check. It's not like insanely good. I want to say
it's only like 5,000.
About 350. Because I rebought not too long ago. I want to say it's going to be in the like 40s or something, but this is going back to me saying like there's a lot of companies to buy out there. Like after this report, do you really hate buying a company like this? That's going to have improving gross margins. That's like got international expansion out the wazoo. That internally, like the energy market's growing. Yeah, it's in like the 30s, 40s%.
And then for Henry's comment, yeah, especially right now, there's a larger flight to safety. I think more recently, there's been a small push, but nothing too major. But the multiple expansion all of them have experienced is telling, and maybe also concerning.
Well, Monster hasn't really had a multiple expansion. The other ones,
not Monster, the others. Costco. Oh my gosh, Costco's multiple. I think. What's the average for Costco? Let me check the average multiple.
No. We don't talk about Costco.
We don't talk about Costco.
No. So, actually, Monster's experienced valuation compression.
Oh, so it must be a buy. But Costco, I want you to guess, Andrew. What's Costco's average multiple? And I'm looking at diluted EPS.
Average meaning
over the past since like the early 2000s till now, what has been that
Early
median
2000s till now?
multiple? Yeah. It's going to shock you.
30.
Very close. 27. You know what it is right now?
A lot more than that. I'm going to guess this is forward multiples.
No, current. And I'll get the forward for you.
See,
the forward's not even that much better. The forward's not even that much better.
I'm cheating because I know it's high.
Okay, well,
I'm going to say 70.
No, it's not that high.
See,
But
that's the thing is like, I'm sure it's insanely high for
it's insanely high for
retail.
what they're growing at. And so, see, like I was shocked by playing that game with the club that I even made money. I made 16% on the Costco position. Consuelo voice it. So the forward multiple is 47. The current multiple is 50. The average is 27. That thing has expanded.
Yeah. So, but do they still have a long growth runway? Like, what's their
growth runway right now is China and increasing member dues. I think that's the okay. So the reason for the multiple expansion, and Jesse has said this as well, is probably pricing in that they have the ability to at some point increase the margin fee. The membership fees, and so that's where the profit's going to come in. It's going to roll in from there.
You know what? I can definitely see that because you know how many people make it like their identity, like, oh, I love Costco. I love Costco.
Yeah.
And those people are like, you're going to have to raise money a lot for them to be like, I'm not going to Costco anymore.
Yeah. But Louis, so this is the point, right? 35 is the last 5 years. So you take the whole time period, and that's getting skewed, right? Because of the recent time period. Let me actually go into the data and remove this like pre-COVID. Okay, pre-COVID, Costco, average multiples 24. Now, let me go a little bit further back because they really started to get strong appreciation. Exactly. Back in 2013. Average multiple, when I remove those years, now contracts to 22.9. Insanity. Yeah. It's higher than when interest rates were at 0. Correct?
Oh.
People are willing to pay more for every dollar that Costco earns because it's Costco. And to be fair, it's a very defensible business. It's the one retail company that everyone can point to and say, that's not getting disrupted by Amazon. They're not competing with Amazon, not in the same bracket.
I get it, because if you ask me, like, how is Costco going to lose sales? Like a recession, okay. But I think they hold up better in a recession. Maybe people are looking at the pandemic in 2020 and saying, like, it wasn't affected at all, maybe, in terms of revenue growth. Which, like, at the end of the day, it's people buying groceries. I don't know, like, are people going to...
Yeah. No.
I've never really looked at Costco.
I've looked at it. It's on my watch list as far as a serious investment goes, but I couldn't bring myself to buy shares of it right now. Far from that. It's too pricey.
And Swaggy Pig, so why would a recession hurt it? People look more at where they're spending money. If you're someone that has a Costco membership and you don't go there that often, like, this is my point, is like, I don't think it hurt it a lot. But there are people, like, if you have a membership but you hardly ever go there, maybe you get laid off and go, okay, well, I go to Costco like 3 times a year. I'm just gonna cancel. That'd be my guess. That's kind of the point, is like, I have a hard time seeing, like, recession hurts everyone. There's gonna be people that go down to cheaper or maybe places where they can put smaller increments because Costco you buy a lot. I'm just trying to kind of theorize what would drive a decrease for Costco. Someone asked about the On shoes.
Yeah, you're.
What are you saying?
Yeah, what do you think about that one?
What are they trading right now? Because like 43 PE, 136 forward free cash flow. I didn't realize they had sold off to like 25. I might have considered picking them up at 25. First of all, I like the shoes. I don't own them, but they look nice and like they seem like they're good shoes. I think more than anything, I think this. So we talked before, Celsius doesn't really compete with Monster. I mean, they do, but they don't. On does compete with Nike. So I think if anything, like the takeaway is like maybe look out for Nike. But I think On and Hoka are two brands that are just becoming super popular super fast. And I don't see why like On, because On started in Sweden. Like it's bigger in Europe than it is here, or at least in Sweden, it's bigger than it is here. Here is the US. I mean, I could see them continue to grow at a decent clip for a while. I'd have to do more like research into like what their strategy is moving forward, where they're expanding, how they're expanding, what they're doing. But I somewhat get the hype around this one. You know, it's not super expensive. Like a 43 forward PE isn't like back-breaking expensive. That's not crackhead prices.
Mm-hmm.
But
is this the next Nike?
No one's the next Nike.
No one's the next Nike.
No one's the next Nike. Like I'm saying, they might take incremental share from Nike. Nike's gonna be Nike. No one's gonna be able to sell freaking tennis shoes for thousands of dollars because it's a limited edition, like Nike can. Well, that's why you're called the intelligent observer.
Yeah, Mark's with you.
Yeah. Oh, is that Mark?
Yes.
Oh, what's up, man? I just thought he was the intelligent observer. I'm like, oh, hell yeah, you are.
This is read very interestingly, but I know what you mean. And I think that BJ's has that lower multiple, but that doesn't necessarily mean it's a like they deserve to have the same multiple. And I'm not saying that's what you're saying, but I believe that BJ's has a lower multiple and deserves it. And I think that where it's trading at now is relatively fair value. Wholesale clubs, it's difficult because we only have Costco and BJ's to go off of. But what were you gonna say?
I've never been to BJ's. What's it like?
Think of Costco, but smaller. Okay. So bulk buying, but in smaller quantities than Costco. So some people say if you have smaller family, you can go to BJ's and you won't get overwhelmed with how much you're going to be buying.
That makes sense.
You have to buy so much when you go to Costco. And it's a cheaper membership. It's, again, reflective of kind of what you're going to be buying. So if you have a small family, one child, or maybe you live by yourself, or maybe it's you and a spouse and just that, BJ's fits that niche. While Costco is more so for you got a big family. You know, there you go. Oh, yeah. Okay. Everyone's coming in with the BJ jokes.
I have someone very close to me, and when I told them, because they had never heard that there was, I've seen the store. I've never like been in it, but I can't remember why it came up in conversation. But I was like, yeah, BJ's. And they're like, they thought I was like joking with them. They're like, that's not a store. Like, no, it's called BJ's.
I don't know what the rationale was. I'd have to see the rationale. This is not like, well, Cameron Stewart, one of the creators that I did kind of ding on for his PayPal valuation way back in the day, he showed how he came to his valuation. And so I was able to pick that apart. maybe I'd have to look at the video and see how he pencils it out.
I don't know what the story is.
Or if he just pulls it out of nowhere and says it's going to 2x, then I don't know what to do with that. But
I'm trying to see why. I'm sure it's like the guy's initials that started it. Yeah, Beverly Jean. What? It's the person's initials that started it.
oh, uh-oh.
Are people asking club questions?
I will not stop you from answering it if you want to.
Should we talk about this, or do we want to talk about your next big bet?
We'll talk about the next big bet.
And then, if we want to, I don't mind talking about it. This is public though, but I don't care.
Yeah, we can touch it.
I really don't mind.
Okay, then that's good. All right, so the next big bet, talking about it roughly now, but it's something that I've already kind of gone like, when did we really address this? 2 weeks ago, the ICOM? I think it was 2 or 3 weeks ago.
What are we talking about?
Sterling.
Oh, yes, yeah.
So broadly speaking, infrastructure.
So yeah, it's hard for me because I forget, like, I'm trying to put together like the last time you did public, okay.
I know, and this is, I'm at a huge disadvantage too, because even when I was doing the portfolio update, because I'm still with my flu, my brain is still foggy, and so doing this live stream has been tough, but necessary. So yeah, you see, I've been doing like more extensive pauses today, and if I stand up, that's when I get dizzy. But anyways, I think it was 3 weeks ago, if my memory serves me correct, and it was a pivot into. So we already had the plays for semiconductors; those were already in. We were discussing it in one of our private club live streams, and suddenly, how did we broach the topic? How did it start?
Did it start with NVIDIA?
We were talking about another investment, Arista.
Yeah.
And then we were going over certain things, and then I was like, wait a minute, Andrew.
Did you pitch Sterling like a while ago?
Yeah, wait, what happened to this? Let's go into the filing cabinet. Let's pull this file out. What happened to this company? This seems like it would benefit tremendously from these tailwinds that we're identifying. And then you're like, oh yeah. But you pitched it a long time ago.
Mm-hmm.
I think over how many? It's over a year now.
I can tell you when I pitched it because that's when I bought it. And a lot of these companies, I like to hold like small watcher positions even when I sell them, just in case like they come down or come back to something, depending on why I sold them. So is it this one? I don't even know what I want to say. Actually, because I can tell you, I know my original purchase was somewhere around 30 a share.
Yeah, you pitched them in Rode, and then you said Sterling is your favorite.
Mm-hmm. Yeah, so it would have been like probably Q3 of 22. Q2 to Q3 of 22, I think is when I.
And then so we brought it back as far as like a reminder, and it flattened out for a bit. So we were able to kind of catch on to it before the recent explosive rally. So that's what's exciting. And I know a lot of club members also were very excited when the earnings came out. But in summary, what does this company do? Well, they're a construction infrastructure play. Not in the materials whatsoever. That's what CRH is. But Sterling does two things that we focus on, which is e-infrastructure, which is their higher margin business, and then additionally their transportation business, which is their roads. So what this recent call was all about was kind of showing, okay, revenue growth wasn't the greatest, but wasn't the issue at all. What really surprised analysts was the insane amount of margin expansion across the board. And that's what really shocked them. And on top of that, what the forward revenue growth is going to be also was very appetizing. Let's just say that. And so their backlog is pretty neat. It's pretty good, pretty extensive. And so what this company basically benefits from on a high level is you have the transportation business, which I think is very easy for most people to understand. By the way, did you see in the call that they are expanding that business into the southeast, into Rhodes territory?
No, but that makes complete sense. I still haven't. I've been a little busy, and there's some other things grabbed my attention, so I haven't come back to look at.
So do you remember when I bought the big chunk right before the earnings, and the reason why? I remember what I messaged you guys, because I listened to Deere, and what did Deere say? So Deere's other businesses not so hot, but one business of theirs is doing really well and still projected to do really well, and so that just gave me that extra bit of confidence I needed to just buy a bit more before earnings. And construction. That was construction business for Deere. Specifically, their commentary on infrastructure construction, because there was the parts where they separated for commercial and residential, and then infrastructure. And they said infrastructure is expected for Deere's customers. It's going to be a huge growth driver, demand driver, and so that business of theirs is doing well. Agriculture is doing poorly. That's why Deere sold off. But that's all I really wanted to hear. I was like, heck yes. And then I want, Andrew, I'll let you explain this part. E-infrastructure.
Yeah. So they are the ones that are building I mean, it's exactly what it sounds like, but I guess they're the ones that are helping build the actual physical reliability or reality for data centers and items in that. So, if NVIDIA is getting all this money from putting in their massive units in building out AI data centers, well, someone else has to actually build the data center. That's not all in a vacuum. There's a whole ecosystem. You could almost say that's within there. If you think about, there's the building of the actual building. There's putting together, the super microcomputers of the world that are building like the racks and whatever else they do. There's the Arista networks. There's also, you have to build out the power infrastructure for this, which isn't Sterling. That's something else. But so Sterling is just one of those ancillary components. And the nice thing about Sterling is there's a question on NVIDIA that I don't know the answer to, which is, are they going to be able to maintain their market share, their dominance in data center? I don't know. I'm not my circle of competence. But Sterling, I feel pretty confident they'll be able to continue to do this building, because it's not the sexy business that semis is, It's like, it's relatively easy, or you're not going to have as many people coming in trying to take that. It's a building project. People are going to feel confident with you. They're going to come to you and say, can you get this done in our timeline? Yeah. Okay, cool. Go for it. And Z-Star or Zstar, Sterling, they're saying, why so many there's so many builders, why Sterling? There's not a ton of builders that have this kind of exposure to e-infrastructure. Also, Sterling is one of the things I like is when I was deciding between them and Rode, one is I like their e-infrastructure, but two, I like when management can be very clear and like communicate what they're trying to do very well, and they can do that. But like ultimately, they have much better exposure to data centers, infrastructure, the AI boom, if you want to call it that, than anyone else that I know of. That was part of the original pitch. Yeah, exactly. So Agadi says it's more predictable. I think that's a good way to put it.
Yep, far more.
And there's less downside risk. Yeah.
So, I mean, you did mention that the management quality, that's another thing that went into that. You even said, I love Sterling's management. And they even, I think they say it inside, they coined the term the Sterling way. They actually recently bought a plumbing business, not for like plumbers, but to lay the plumbing. And so that's also been able to increase their margins on their projects because they used to work with that company on their projects, and now they just acquired them, and they're going to expand that business into all their projects. So
this we talked about this with Builder, and we don't need to get into that company too much, but I think this will go not to the same extent as them, but this is a kind of industry where you as the
biotech's coming in. The stock is not good.
We'll talk about Viking Pharmaceuticals next.
Yeah, we'll talk about Viking.
Which, by the way, we have to give this man, didn't he do a write-up on them?
He did a write-up on like 5 or 6 stocks in the club, and every single one of them has gone like parabolic.
Dude,
he's hating it right now. Every day that he looks though,
I see biotech like as an industry, I'm just like, okay, whatever, like ignore you. And this man's over here like fucking hitting home runs. I'd be pissed too if I was him. It's like, why didn't I just buy calls on everything? I'd be retired now.
Yeah.
But my point was going to be, I think these kind of companies, they're going to do acquisitions. They're going to expand to grow those margins. It's going to be slow. It's not something that happens in an instant, but that will be not to the same extent as suppliers like builders for a source, but that will happen.
Yeah. And we had this is a question we can quickly answer. So the difference between infrastructure and e-infrastructure, general infrastructure. The difference between the two that can be explained in the simplest fashion is one is focused entirely on the development of the development of.
He said, were you in it before the run up? No.
Stop reminding
me. He did a write-up on it.
Yeah. I don't know why you don't invest in your own write-ups. Like, I think everyone in the club who does write-ups, they invest in their write-ups. You're the first person to be like, yeah, I did a write-up on them. Did you invest in them? No.
So what he needs is validation for us from now on.
Dude, no, you've been validated. Like, I'm next write-up, I want to be like,
dude, I am free thinking so hard on that next write-up. Let me tell you.
I'll give you a cut, by the way, if it works out.
He's gonna find some terrible biotech and just trick us into buying it.
No,
like,
no.
Oh yeah,
that's why I'm gonna incentivize him. I'll give him a cut. Like, if it works out, I'll give him a cut. Bro, the next thing I pitch is going to 0. Yeah, that is true, because there's no way a human being can because it's every single one. That's what was funny and meme-ish about it. And it's not like he benefited from it. It's like every single one he pitched. What was the lowest biotech, since you're in the chat? What was the lowest return rate of the ones you pitched? Because there's all in one write-up, by the way. So it's not like multiple write-ups over time. He did one big write-up with multiple ideas, and it was ridiculous. There's no chance I get another one right. Yeah, there's no way. Everything from here on out is just downhill. I think like the worst performing one is probably like 60%. Like that. Oh, never mind. AXSM. Okay. Well, I would have been kind of underwhelmed if it was 5. Dan, it's different kinds. I pivoted into specific kinds of industrial. Well, industrial, is it really like that much of an... I'm technically still in that, overarching AI play, in a way. This is funny.
5x.
Yeah. Viking Pharmaceuticals 5x. Dan?
Wait, so here's the question. Is the run-up done? Is this like a Moderna where we're like, hold up, wait. Is it too late?
Well, read the write-up, because it might not be for some of them. We basically got validation for some, and yeah, it might be too late for some, but for some of them it might not be too late. Just tell me it's fine, I'll cry later. I didn't sell the whole position. I trimmed it.
I haven't sold any, Dan.
Oh, kiss ass.
I haven't though. I mean, I still hold it.
Kiss ass. Yeah. I sold. I'm sorry. Andrew forced me to do it. He told me Coupang is coming down. Death by 1,000 cuts. You told me you'll cry later. I read that you wouldn't cry. But anyways, so to the question, infrastructure is simply infrastructure for the purpose and dedication of what we call as the not Internet of Things, but cloud connectivity, cloud infrastructure, data center infrastructure. So, and then regular infrastructure you can think of as, your roads, etc. So those are the two business lines that they have outlined for you. Infrastructure right now is their higher margin business, like I said earlier. But anyways, that's more or less the pivot. You guys saw, I guess, publicly on YouTube that Sterling's, this position came out of nowhere. It's number 6. I believe in the holding co. What is it? The third largest holding after the run up. Yeah.
Okay.
After the run up. Let me check on the holding co. Report update from the last update, which was like yesterday. Yeah.
Yes, pharma. We covered Monster.
Yes, we did. Yeah, it's it outpaced Taiwan Semi. I can't even afford Microsoft Word. Can't write up. Man, this bullying right here.
You guys are ruthless.
Yeah, no, leave the man alone. He hit like 5 home runs. Well, no. We'll take away one of them because it was only 5%. It's trash. Oh, by the way, it was over the time period because the time period matters. I think he did the write up in December. So if you oh my god, if you annualize that rate of return, oh, that was it'd be ridiculous.
We have
Anyway.
done a service to the community.
Yes, he would have.
No, we have. That's what I'm saying.
Oh, yeah. All right. I'll leave open topics. Andrew, is there anything else you want to cover?
Just trying to think of any other earnings that we want to go over.
Well, I'm going to stop you right there. We can talk about what everyone should talk about. Tesla and the new Roadster. Look, Andrew, I know you're really excited to talk about Tesla. Everyone talks about Tesla because it's the most powerful, brilliant company in the world. And I'm already losing Andrew. I can't get him to talk. All right. What is the topic you want to go over?
No, there's all these YouTube like finance or FinTwit companies that when people talk about them, my eyes roll in the back of my head. And Tesla's one. Not that I hate Tesla. I think it's a really well-run car company. But I don't know. Just to me, it's not super interesting. And it's definitely not within, I guess, my sphere of competence. Do we want to talk about a certain stock that fell a lot?
That's up to you.
Okay. Let's see. So, yeah, I think we should, just because we had a call about it, but we didn't update it, because I think we talked about it. You listened to the earnings call, but we didn't do an update for the community because we had the call last night where I talked about this, but that was before it sold off way more today.
All right, so we're going to be giving this out. So let's make it public.
Yeah.
Let's go for it.
So IAS, Integral Ad Sciences, reported earnings, and they got clobbered, destroyed, down 41.5%. My opinion is this is a massive overreaction. Massive, in my opinion. So, the average, just so you know, the average sell side analyst was they missed top line full year guidance by 3%. So like just to put that into perspective. Now they're not the ones that are necessarily selling or this all or not, but so IAS, what do they do? Integral Ad Sciences, they do measurement, media quality. Basically, they help you as if they either work with a website like Meta or Google, or they're going to work with someone trying to run an ad campaign, and they're doing measurement for you. They're trying to say, hey, your ads, they'll give you feedback or data on your ads saying how well they're doing. They'll also make sure that your ads are brand suitable. You don't want, I'm trying to think of an example. You don't want your Christian church advertisement being run on a Satanist website. Probably not like where you want that to be. Or an atheist website, atheists.com. I don't know what there's a community, but that's what they do. So what happened? They reported earnings, and the biggest question was that, Swag, I don't think you can say that on YouTube. That's why I was trying to think of a different one. But so they report earnings, and obviously they beat this quarter, which normally if you see a thing like that, you think current quarter missed. Like I see someone down 42%. I'm like, they missed current quarter, they missed guidance, they missed everything. They hit this current quarter, fine. Management gives guidance that's soft. Okay. And more than anything, they gave guidance that Q1 was going to be very soft, but it's going to ramp into the back half of the year. The commentary they gave was, we re-signed some new contracts. Those new contracts gave us additional volume promises, and they're like 1 to 3 year contracts in general. So, but they gave them additional volume minimums at a lower take rate. So this is going back to my comment that I made kind of like about, it's not like about the PayPal take rate issue.
Hey, guess what?
Oh, I thought I heard something. Sorry.
No.
And so the question was, there was a couple questions. One was, well, then actually, let me get back. Then, so their full year guidance. Now they got an adjusted EBITDA, and they have about 83% EBITDA to cash flow conversion rate. So I just did that. Like the quick math was, they gave a midpoint of 175 million on adjusted EBITDA. You multiply that by 0.83, 145 million free cash flow for the year, which is an increase. I mean, you're talking a solid 10-ish% increase. Nothing like super amazing or anything. But as I said, they're basically saying we're going to take a little bit of pain right now, or a little bit of decel in the first quarter, and it just ramps into the end of the year. People were worried, okay, are you losing market share to your primary competitor, Double Verify? Double Verify reported, because one of the things was, you made these contracts. Are these all, is this a macro thing? Are you being defensive in nature? And they even said, yeah, we're being like a little defensive. And I kind of appreciate that they're just like honest about that. Well, Double Verify reported today, and Double Verify said weak Q1 guidance into ramp in the second half of the year. Exact same guidance and commentary as IAS. So, and this was, they reported that afterwards, but I thought that IAS was going to be primarily a macro thing. And so now Double Verify is growing at a faster rate, but it's the same kind of dynamics that you're seeing. So the way that I see this is, you are getting potentially a technology company that's growing, we'll say mid-teens top line. They're guiding for, I think their free cash flow conversion would be roughly the same, but they're guiding to slightly lower EBITDA margins, but their EBITDA margins, it's adjusted that they guide to, is backing out SBC, and they are guiding for lower SBC this year. So I think margins, like if you normalize everything, is about the same. but let's just assume slightly declining margins and they stabilize in the mid 30s. But you're getting a company that's growing top line at 10%. We'll say bottom line at like 8% for 10 times free cash flow. And if anything, I think that they'll ramp, and then like the commentary from management seemed like this isn't going to be an ongoing problem. This is a one-time thing, and then moving forward will accelerate. The other thing that they pointed out, they signed a really big contract with Meta for Reels that just went into effect in February. So as that ramps, it doesn't all go live one day. So basically my point is I think this is an insane sell-off by the market. To me, I'm not saying that I'm like all-knowing or anything on this, but to me, this seems like an overreaction. And I think if you buy in today, it's like, that's insane. If you buy in today, you're going to get this company at, first of all, single-digit EBITDA multiples. Either single-digit or like pretty close free cash flow multiples. And I think that moving forward, for example, I don't think 2025, you're going to see decel in revenue growth. I think it's going to accelerate. So then you're going to get back to like the mid-teens growth amounts. So that's kind of my like thing that I'm saying. And it was, I think, good to see that, Double Verify's commentary was like, oh, we're not sacrificing pricing. We're not doing that. We're not going to do that. But then they're like, oh yeah, but like their commentary was, oh, well, the reason that our ramping or our Q1's so bad is like we signed new customers and they haven't ramped yet, which maybe that's true, but to me it sounds like maybe a similar macro. And Double Verify is known to be not as transparent as IAS. I don't like their management. So I think it's not I don't think it's misfires on execution. I think it's more of a macro issue. That's kind of.
And going into the later part of this year when we have elections coming through.
Yeah. I don't think that's, I mean, they say that they plan for that, but like, how do you forecast that?
Yeah.
And also, I mean, management guidance is management guidance. I don't need to get into the fact that they're probably going to like beat guidance, because that's usually this management team does is guide low historically. But I think that they're primarily overly discounting however much the elections will be this year.
And for full disclosure, are you long IAS?
Oh yeah. Full disclosure, I'm long IAS. If you couldn't tell, yeah. And full disclosure, I was long before the sell-off, but I bought a lot more today.
I am not long IAS, but
trader.
But I'm thinking on it. Right now, the problem is just the holding co has no cash, except if I have to draw from the cash account, but I don't want to do that again. And personal holdings, I don't want to reduce the cash position.
The other thing, so Swaggity is just asking a question I kind of want to answer because it kind of brings out another point that they said about these contracts. The contracts that they're re-signing are really large entities. One of the things they said was the reason they did this was because of the model these companies have is land and expand. Usually they have multiple offerings. And so the idea was we're going to do this and then cross-sell. And so they should be able to then grow with these larger entities and ramp up revenue. I don't factor rate cuts into any of that.
Yeah. Okay, fair enough. So before we close off today, there's one more topic that Henry asked us to go over. And this is a company that you're really heavily invested in. That's Warner Bros. Discovery. I have to gaslight somehow. All right, but anyway, no, he's not.
Did they report?
They did report, and they went down. So now they're down to $8.70. When I did my rough valuation on voice chat with club members, I actually came up with a rough valuation updated to the more recent numbers. This was before the earnings at around the $8 of strong interest. But the question for me becomes, is it yet another streamer that I want exposure to? And that's probably what's going to stop me. But the current valuation seems quite appealing. And I know that some club members did build out their positions more. Some new ones joined in, and some actually left it because, hey, it doesn't. Funny you say this, but
I think they're
I
different.
think it's different. They're very different.
I think they're both good opportunities, though.
Yeah. So Warner Bros. Discovery. I think we'll break down exactly what the issues are. I think the main issues are that they didn't give guidance, and that freaked everyone out. Immediately when they said, "Oh, we're not going to give guidance," except they give guidance, I think, for 2026. The platform is growing at a snail's pace, and this is concerning. When you looked at the Paramount plus Warner Bros. Discovery, hypothetically, if they were to merge, they still wouldn't get close to Amazon. They wouldn't beat Amazon. And Disney, when you combine Disney plus Hulu, they do surpass Amazon. But by the way, Amazon has become a huge player in streaming, which is crazy. And then Netflix, forget about
messing up on all their shows, but
yeah, they better not mess up Warhammer.
We don't want to get into like this streaming topic. We're known to drone on about streaming stuff.
Yeah. But anyways, you have another streaming stock here, right?
Mm-hmm.
And this one, there's some really exciting catalysts that might propel excitement around the streaming platform in the future. Mainly, and I think people underestimate this perpetually, Harry Potter. The Harry Potter TV show, yes.
Oh.
Yes.
I don't know.
And they're going to stick more closely to the books than the movies. So, because they are going to get more time. I'm really going to be scared how they.
So they're redoing like the Harry Potter story from the books,
but as a TV show,
as
a series instead of a movie. It's a series.
They couldn't do something adjacent?
No. Yeah, and that's what they are going to go through, and the community of Harry Potter is absolutely massive. I think it dwarfs most of the fantasy fan bases. Now, they also have another upcoming Lord of the Rings, I think based on Rohan. I think that's supposed to come out this year as far as films go. But anyways, I'm not.
Oh, this is Warner Brothers or Amazon?
Yeah, Warner Brothers. No. If it was Amazon, it'd be like Ride of the Rohirrim, like, and that's what the movie would be called. Like, the only reason why I have faith in Warhammer is that Henry Cavill has been given executive producer, and Games Workshop is very tight about their IP. Apparently, the Tolkien estate's like, yeah, you can do whatever you want. So it's like, what?
Right. Well, because technically, the Tolkien estate feels like they already threw away like all the creativeness or like what they thought Lord of the Rings was when they let the movies do it. But that's another.
Yeah, you're right. So let's break down the numbers here. So basically, when you break down the numbers, you got a company that's producing a ton.
But they are massively levered?
Yes, you got your company that's producing a ton of cash flows. But here in this case, you have a very indebted business. And when they broke away with providing guidance, now that brought into question a bunch of things. People started to worry, okay, what does this mean? Are you going to be able to pay off your debts? Now, if you look at the debt stack, how the maturities, it's not really much of an issue as far as a refinancing risk goes. And they've actually paid off a decent amount of that debt. So some of the club members who who are paying attention to that as sort of a barometer of success. They're saying, okay, well, I'm seeing the company pay down debt successfully, so management is checking my box and they're doing what I want them to do. So then they felt, okay, I should reward this investment, this behavior. The share price is coming down. Is it for reasonable reasons, lack of a better term? And what I'm seeing here, okay, undoubtedly it's cheap at this price. I think that the concerns are simply around how are they going to draw more traction to the streaming platform, because they've already kind of focused on going in that direction. I don't really see an issue with the licensing model. And they've already moved a little bit in that direction where they started licensing out their content to Netflix. In fact, if you go on Netflix right now, you'll see a lot of DC content. So a lot of Batman shows, a lot of DC stuff is on Netflix right now. And that's all because Netflix has been paying them. They've been licensing out that content. And Netflix still, not generously, but has a massive lead over everyone else in terms of viewership. So the opportunity here lies in that this guidance withdrawal was an overreaction. We know that they had a short-term cash benefit last year due to the writer's strike of about $1 billion. But even when you back that out, they still produce a good amount of cash flow. And if they continue to pay down the debt, which they said is their priority this year, in a couple of years, the debt should be at really manageable leverage ratios. So not that it isn't right now, it honestly kind of is based off of how it's broken out. But just bringing it down a bit would, I think, calm investors a lot more. People don't want to pay to watch movies anymore. They just want one streaming service, then just watch YouTube. Well, the data shows, yeah, that the top streaming platforms like Netflix and YouTube. But the movie theater comment, I'm not entirely sure. I think it's just changing, and movie theaters are becoming more of an experience. So I think movie theaters were overbuilt, and I think it's still a place to kind of go out to do. I don't think that's necessarily dying. In fact, in the movie theater space, there have been some movie theater investments that have been really well. One of them, unfortunately, is private, and they're doing apparently really well. It's a European company, and they bought the best U.S. theater company. Because one thing that's interesting about the economic dynamics of the industry, it's way better if you own the theater, the real estate, and most of them don't. So most of the ones in the U.S. that are publicly traded do not own their own locations, and like AMC, the famous one. But the one that was publicly traded in the United States, that was actually the best performer, actually got bought out by the privately owned European counterpart that also does the same strategy where they also own the locations, the physical locations. Anyways, enough of that. Dune 2 is coming out, yeah. So, but all that's just kind of talking about the content. But really what it comes down to is how much cash flow can they produce and how much debt can they pay down, and then how much capital can they return to shareholders. One thing that one club member said, they also kind of think they're right on this, is if the share price is really cheap right now and the debt stack isn't much of a problem for the near term, why don't they just use that excess cash and just buy back some shares right now? They would prefer to at least alleviate that debt burden and focus on that. So that might be a ding on their capital allocation, in your opinion. And they're able to buy back their debt at cheaper prices right now, because right now their debt's going for less. But he's claiming it was worth $20 a share. I haven't heard of. Oh, I've heard of Kevin's mini funds, but I haven't looked into it, honestly. If debt is reduced, perhaps the IPWD can provide a floor to the stock price. I mean, no, yeah, for sure. If the debt is reduced, I think that's the only issue. If the debt wasn't there, this stock would be way higher, because if you look at the company from an enterprise valuation, so if you use enterprise value and do any sort of division, I don't know, EBITDA over enterprise value, you get you get a different view on the yield of the business, and it's not as attractive when you look, or wasn't as attractive when you looked at it from that perspective, because the market cap's what, 20 billion, but the enterprise value 60, between 60 and 80 around there.
Or Warner Brothers?
Yeah, it's way higher than the market cap. I think it's 60.
65.
Okay, 65.
Not 66, but
Yeah, Fabio just ranted, Fuhat says.
I just think it's hard to sometimes buy companies with like a net debt to EBITDA ratio above 4. Like that, even 4 is kind of pushing it for me.
Mm-hmm. What's theirs sitting at right now? Oh, right there.
5.5.
Yikes. Yeah. I mean, they have a chance to do it because of the maturities. So a lot of it doesn't mature for a long time.
I mean, it doesn't matter if it matures really, because they'll just be able to get more debt and roll it out.
I'm saying, like, for if the debt, well, no, what rates they would get, it would kill them. Because right now the average interest rate on that debt's pretty low.
Oh, is it?
If they had, if they had to refinance that debt today, that would be quite impactful. But thankfully, a huge chunk of it is far out into the future. I think more than 8 years. 8 years plus.
Oh, okay.
So it's fine. All right. I think with that being said, we did 2 hours.
It's like a sprint for you.
Yeah,
just getting back. You're just getting back in the swing of things, coming back from your sickness. Do a little sprint before the marathon.
No, still recovering. I think one more day and I'm recovered from the flu. So, well, with that being said, guys, thank you guys so much for watching. And we'll see you guys on the next one. If you guys are interested in checking out the club, the link is in the description below. If you guys are new to the channel, you can go ahead and subscribe. If you like the content, feel free to leave us a like. And we'll see you guys on the next live stream. And I'll leave you guys with the outro.
Okay. We'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing.